Banks don't fail only because of bad numbers. They often fail because they ignore non-financial risk. In this video, we'll explain how integrating ESG, that is environmental, social and governance factors, into credit risk management can help banks predict defaults more accurately and lend money more sustainably. We'll also look at real-world cases like Yes Bank and BNP Paribas to understand what happens when ESG is ignored and when it is used strategically. Let's start simple. Credit risk is the risk that a borrower, an individual or a company, may fail to repay a loan. Traditionally, banks assess credit risk using financial statements, credit scores, past repayment history. But here's the problem. These models only look backward. They miss future risks such as fraud, poor governance, environmental penalties, or social backlash. ESG stands for environmental, social, and governance factors and is used to assess how responsibly a company operates beyond just its financial performance. Environmental factors include pollution levels, carbon emissions, and exposure to climate-related risk. Social factors focus on how a company treats its employees, maintains customer trust, and complies with the regulations. Governance factors examine board independence, transparency, and ethical leadership. While companies with weak ESG practices may appear profitable in the short term, but they are far more likely to face fines, scandals, and even collapse in the future.
When banks ignore ESG risk, they often underestimate the true default probability of borrowers. Hidden environmental, social, or governance issues can weaken businesses suddenly, leading banks to overlend to risky borrowers and face unexpected loan write-offs and rising NPAs. By integrating ESG into credit risk model, banks can identify such hidden risk early and access borrower quality more accurately. This allows better loan pricing, stronger risk management, lower long-term NPAs, and promotes more sustainable and responsible lending. So, in a revised credit scoring model, ESG is integrated alongside traditional financial analysis to provide a more accurate risk assessment. The model begins with conventional financial score based on income, leverage, and repayment history. This is complemented by an ESG risk score that captures factors such as environmental penalty risk, governance red flags, and regulatory or reputational exposure. Both scores are then weighted together to arrive at a final credit score, where the financial and ESG assessment combine to reflect the adjusted default risk. This approach does not replace the financial analysis, instead, it strengthens it by offering a more holistic view of the borrower risk. Now let's look at a real Indian example, Yes Bank. Before its collapse, the bank suffered from weak governance practices, high exposure to stressed corporates, and board oversight and risk control. Traditional financial metrics failed to fully capture critical risks such as governance failure, an aggressive lending culture, and management-related issues. The result was sharp rise in NPAs, loss of depositor confidence, and eventual RBI intervention in 2020. If governance risk had been embedded in credit risk model, many of these early warning signs could have been identified much earlier.
Now let's look at BNP Paribas, a global leader in ESG-based lending. The bank actively integrates ESG scores into the corporate credit decisions, linking loan pricing to borrowers' sustainability performance, and systematically reduces exposure to environmentally harmful sectors. This approach has resulted in lower long-term credit losses, improved risk-adjusted returns, and stronger alignment with regulatory expectations. BNP Paribas clearly demonstrates ESG is not a cost burden, but a strategic risk management advantage. To successfully implement ESG-based credit risk frameworks, banks should take a structured and policy-driven approach. ESG scoring should be made mandatory for all large value loans, while borrowers with weak governance practices should be assigned higher risk weights. Banks should also invest in training credit teams to identify and assess ESG related risks effectively, and to ensure that the ESG metrics are aligned with the RBI guidelines and global regulatory frameworks. Together, these measures enable sustainable growth without compromising on profitability. To conclude, ESG enables banks to identify risks that are often missed by traditional financial analysis alone. Ignoring ESG factors can result in costly failures, as seen in the cases like Yes Bank, while strategic ESG integration can strengthen credit quality and risk management, as demonstrated by BNP Paribas. The future of lending, therefore, is not about profitability alone, but also about responsibility and sustainability.